Are we stepping back into 1999? Warren Buffett, the Oracle of Omaha, is issuing a stern warning about the stock market. He predicts that the next decade might not look like the roaring years we've recently enjoyed. Instead, it could resemble the challenging days following the dot-com bubble of the late 1990s. But why does Buffett believe the market will be tough for the next 10 years? What lessons can we learn from history, and how can we as investors prepare for what's ahead? In this video, we'll dive deep into Warren Buffett's insights, unpack what happened in 1999, and discuss actionable strategies to navigate uncertain times. Let's explore what's happening in the markets today and how you can position yourself for success. Stay tuned till the end for key takeaways that could help protect your portfolio. Section 1. Revisiting 1999, 5 minutes. To understand Warren Buffett's current predictions, let's rewind to 1999. It was the height of the dot-com bubble, a time when tech stocks were all the rage. Companies with no profits, no revenues, and sometimes not even a clear business model were commanding astronomical valuations. Investors were swept up in a frenzy, believing the internet would revolutionize everything overnight. And they weren't wrong about the internet's transformative power, but they were wrong about the timelines and valuations. Buffett, however, didn't participate in the bubble. He famously avoided tech stocks during that time because he didn't understand their business models. While many ridiculed him for sitting on the sidelines, calling him out of touch, his patience paid off when the bubble burst. The Nasdaq fell nearly 80% from its peak, and countless investors lost fortunes. Now, fast forward to today. Are we in a similar situation? High valuations, speculative trading, and the rise of meme stocks and cryptocurrencies have raised concerns. While the specifics are different, the underlying psychology, fear of missing out, or FOMO, remains the same. Section 2. Buffett's warning about the next decade, 4 minutes. So why does Warren Buffett believe the next 10 years will be tough for investors? One key reason is the valuation of stocks. Buffett often uses the market cap to GDP ratio, also known as the Buffett indicator, to assess whether the market is overvalued.
Right now, that indicator is flashing red, suggesting that stocks are priced for perfection. When valuations are this high, future returns are often muted because there's little room for growth without significant earnings improvement.
Another factor is rising interest rates. For the past decade, we've enjoyed historically low rates, which made borrowing cheap and fueled growth in both the stock market and the economy. But with central banks raising rates to combat inflation, the environment is changing. Higher interest rates make stocks less attractive compared to bonds and other fixed-income investments. Buffett also points out the risk of slowing economic growth. Over the long term, stock market returns are closely tied to GDP growth. If the economy struggles to grow at its previous pace, corporate earnings will likely take a hit, and that will weigh on stock prices. Section 3. Lessons from Buffett's strategy, 5 minutes. What can we learn from Warren Buffett's approach to investing during challenging markets? First, let's talk about patience. Buffett has always emphasized the importance of being patient and waiting for the right opportunities. He often says, the stock market is a device for transferring money from the impatient to the patient. Second, Buffett focuses on value. While others chase growth and speculate on hot trends, Buffett looks for companies with strong fundamentals, businesses that generate consistent cash flow, have a competitive advantage, and are led by capable management. During the dot-com bubble, Buffett invested in companies like Coca-Cola and American Express, solid, established businesses with proven track records. These companies might not have been as exciting as internet startups, but they were reliable and they weathered the storm. Lastly, Buffett stresses the importance of staying within your circle of competence. Don't invest in things you don't understand. In today's market, this might mean being cautious about speculative investments like meme stocks or cryptocurrencies if you don't fully grasp their risks. Section 4. How today's market compares to 1999, 3 minutes. Now let's draw some comparisons between 1999 and today. Back then, tech stocks were trading at sky-high valuations because investors believed they were the future. Today, we see similar enthusiasm around sectors like artificial intelligence, renewable energy, and fintech. While these industries undoubtedly have long-term potential, the question is whether their current valuations are justified. Companies with little to no profits are commanding massive market caps, just as they did in 1999. Another parallel is the rise of speculative trading. In 1999, it was day traders buying and selling internet stocks. Today, it's retail investors driving up the prices of meme stocks and cryptocurrencies. Social media platforms have amplified this behavior, making it easier than ever for investors to act on FOMO. Section 5, Preparing for the Future, 5 minutes. So how can you prepare for a tough market ahead? First, diversify your portfolio. Don't put all your eggs in one basket. A well-diversified portfolio can help you manage risk and reduce the impact of a downturn in any single sector. Second, focus on quality. Look for companies with strong balance sheets, steady earnings, and a history of weathering economic challenges. These businesses are more likely to survive and thrive during tough times. Third, manage your expectations. If Buffett is right, the next decade may not deliver the kind of double-digit returns we've seen in recent years. Adjusting your expectations now can help you make better decisions and avoid unnecessary risks. Lastly, keep some cash on hand. In a tough market, cash gives you the flexibility to take advantage of opportunities when they arise. Buffett himself is famous for holding large cash reserves to deploy during market downturns. Conclusion, 1 minute. As Warren Buffett often reminds us, investing is a marathon, not a sprint. While the next 10 years may be challenging, they also present opportunities for those who are prepared. By focusing on fundamentals, diversifying your portfolio, and staying patient, you can navigate whatever the market throws your way. So what do you think? Are we heading for another 1999 style reckoning, or will the markets prove more resilient this time around? Let us know your thoughts in the comments below, and don't forget to like, subscribe, and visit our website for more insights and tools to help you succeed in the stock market. This transcript is structured to engage viewers with historical context, actionable advice, and thoughtful commentary, while maintaining an educational tone.